Many investors are considering densification strategies in Ontario to continue to add value and increase the rental income they receive from rental properties. We've been seeing more and more investors benefit from Bill 23, which allows you to take a residential property and add multiple units to it, up to 4 units, without having to incur developmental charges. So in this video, I want to share with you the types of money available to you to build these additional units, up to 4 units, and what do you need to keep in mind. So here are a couple of things. One, if you're going to add units to a site, it's really important to do what's called an as-is and as-complete appraisal. Whether you are self-funding the project or you're going to seek capital to complete the project, it's really important to do this as-is and as-complete appraisal. Why? Because whatever money you're going to take up front, you want to make sure you're going to be able to pay it on the back end. Whatever capital you are investing out of your pocket into the project, ideally you want to get a large portion of that back. So this is where the as-complete appraisal comes in handy, because we want to know what is the future value and what is the projected income and expense on what you're looking to build, whether it's a duplex, triplex, fourplex, garden suite, laneway house. We want to know what the future state looks like. And not only that, we want to actually run the math and see what you would qualify for when the time comes for a refinance as a loan on that property. Because we're talking here about 4 units or below, that would be considered residential financing. So can we get you an 80% loan to value as soon as this project is complete and get you a decent mortgage on this property that will enable you to cash flow? For investors who have reached out the limit with the residential lenders, here's something you may not know about. We can actually take a 4 units residential property and finance it under commercial financing, where the lenders take into account the ability of the property to qualify for the mortgage versus you personally, based on your personal income and personal debts. Either way, we want to know, going into these deals, what are you building? What's the future value like? What's the future income and expense like? And run some math to confirm what loan amount is possible on exit. Now, how do you finance the build? Well, there are a couple of ways. Construction financing is actually an option, and there are various construction loans available in the market for real estate investors who are looking to densify sites. And the general rule of thumb is 75% of the current value of the property and 75% of the renovation or the construction loan. Now, these loans can go higher. We've done loans at 85% of the as-is value of the site and up to 100% construction financing. Once we take a look at what you're building, your experience, where you're building it, we can structure the deal and help the lender understand what it's all about and push on these parameters. Now, when it comes to construction financing, there are a couple of things you need to keep into mind. Number one, these loans are interest-only loans. They're typically at prime plus 2, maybe prime plus 3. And the lenders take their interest upfront on these loans. Doesn't mean that we cannot have you pay month to month. We can possibly have you pay month to month. We've done that before, but I'm just, again, giving you the general feel for how these loans are set up. So prime plus interest-only loan during the construction. Lenders like to take their interest upfront, and you have to account for that interest. You have to account for a lender fee. There is potentially also a broker fee. And also, the lenders on construction loans hold back about 10% of the draws they give you to build as a reserve for the construction lien. That's basically the money they're holding to put in the lawyer's trust account, which they will release to you upon the completion of the project and when the units are ready for occupancy. So going into these deals, we want to dissect the numbers, see what is the maximum amount of construction money we can get you, help you plan for the expenses associated with these types of loans, also help you plan for the likely scenario, the worst case scenario. And we can also marry creative financing with these types of loans. We've structured these loans with vendor takebacks. We've structured them with a private second mortgage behind the construction loan. And that's really the idea here. Now, when it comes to construction, generally, these are more expensive loans that compared to you funding the project with your own money. Let's say you've got a line of credit. However, I am always thinking about the risks of money. If you were to take a line of credit and finance a construction, you're tying all of your capital into that one project. And it's always good to have capital on the side as breathing room or as a reserve or for opportunities that may come your way. So, not a big fan of tying a big line of credit into a construction project, but what we can do is we can combine elements of construction financing with your own type of money, potentially with investors' money if you're raising capital, and get these projects to the finish line, help you plan your exit properly, and help you also validate your assumptions, because there are things with these types of projects that can go sideways, and we want to make sure we've planned for all scenarios. So if you've got a project at hand, you're looking to structure financing for it, or if you're thinking about getting into this type of strategy and want to understand your options, reach out to us at info@streetwisemortgages.com.